We are looking at Beyond Meat Inc., ticker symbol BYND, currently trading at $1.02, down 0.015 points or 1.44% on the intraday session as of this very moment. That is the number flashing on the screens right now, hovering precariously just above the psychological and regulatory danger zone of $1 flat. The expectation for Beyond Meat has long been that brand recognition and a shift toward plant-based diets would eventually create a floor for this stock, a level where value investors would step in and say enough is enough. The reality, however, is starkly different and far more brutal. What we are witnessing is not just a downtrend, but a fundamental repricing of the company's survival odds. The market is no longer pricing this on sales growth or future margins. It is pricing it like an option on solvency. When you see a stock clinging to the $1.02 level, the narrative shifts from growth to distress, and that is exactly where we find ourselves today. The gap between the hopeful retail narrative of a turnaround and the cold, hard institutional selling pressure has never been wider, and that tension is what is driving every single tick of this price action today. Let us look closely at what is happening on the tape right now. The stock opened at $1.03, touched a high of $1.07, and has since drifted lower, unable to hold those early morning gains. This inability to sustain upward momentum, even on low volume, is a classic signature of a market that lacks conviction. You are seeing sellers hitting the bid every time it tries to pop above $1.05, effectively capping any potential rally before it can even start. This price action tells us that trapped liquidity is looking for an exit. Every small uptick is being used by bag holders or short-term traders to lighten their positions, creating a constant overhead supply that the bulls simply cannot chew through. We are also seeing a compression in volatility at these lows, which often precedes a violent move. When a stock flatlines near a critical support level like $1, it rarely stays there for long. It either bounces hard because buyers defend the line, or it breaks through and triggers a cascade of stop-loss orders that pushes it into sub-dollar territory. Right now, the tape suggests the latter risk is rising by the hour. Before we get further into the mechanics of this potential breakdown, I want you to pause and look at the broader context of this decline. Most people think a stock price is just a reflection of buyers and sellers agreeing on a value. But in a situation like this, the price is actually a signal of credit risk. The bond market is often smarter than the stock market, and right now, the debt restructuring news we have seen recently is casting a long shadow over the equity. The fact that we are trading at $1.02 tells you that the equity sliver, the ownership stake you hold, is being viewed as highly speculative by the smart capital. They are looking at the debt stack and wondering if there will be anything left for shareholders if the company cannot turn cash flow positive soon. This is the contrarian take that you need to internalize. Low prices do not always equal cheap. Sometimes low prices equal high probability of further dilution or distress. This brings us to the immediate technical picture. We have a 52-week low of 50 cents and a high of $7.69. Just think about that range for a second. At one point in the last year, this stock was trading nearly 8 times higher than it is today. That kind of wealth destruction creates a massive layer of overhead resistance. Everyone who bought at $2, $3, $4 or higher is now holding a loss. Human psychology dictates that many of these people are just waiting to get out at break-even, or at least with a smaller loss. This means that even if a catalyst arrives, say a new partnership or a sudden spike in demand, any rally will face a wall of selling pressure from these trapped longs. This is why the stock struggles to gain traction. It's not just about the fundamentals today, it's about the ghosts of trades past haunting the order book. Now, I want to address the short-selling dynamic, because this is what everyone is whispering about in the forums and chat rooms. There is a persistent belief that a stock beaten down this much must be a candidate for a massive short squeeze. Let us look at the actual data. Short interest in Beyond Meat remains elevated, hovering around 14 to 15% of the float. That's significant. It means a large portion of the available shares have been borrowed and sold by betting against the company. However, you have to understand the nuance here. High short interest is fuel for a squeeze, yes, but you need a spark to ignite it. Without a fundamental catalyst, like a surprise earnings beat or a massive guidance hike, shorts have no reason to cover. They are comfortable paying the borrow fees because the trend is their friend. In fact, the recent price action suggests that shorts are adding to their positions on every pop, betting that the company will eventually face a liquidity crunch or be forced to execute a reverse stock split to maintain exchange compliance. Speaking of borrow fees, we are seeing some fluctuation there. When borrow fees spike, it indicates that shares are becoming hard to locate, which can sometimes signal that a bottom is near or that a squeeze is building. However, recent data shows that while demand to short the stock is high, it is not at the crisis levels we saw during the height of the meme stock mania. This suggests that the short sellers are disciplined professionals, not just reckless speculators. They are systematically targeting the company based on its balance sheet weakness. Institutional activity in the dark pools, private exchanges where large blocks of stock are traded away from the public eye, is also telling. We're seeing off-exchange short volume ratios frequently exceeding 40%. This means a huge chunk of the selling pressure is happening behind the curtain, shielding it from immediate retail view, but weighing down the price nonetheless. If you're just watching the lit market, you are only seeing half the battle. The real war is being fought in these dark pools, where algorithms are aggressively managing risk. I want to hear from you on this. Do you think the short sellers are simply predatory here, or are they correctly identifying a business model that is fundamentally broken? Comment below with your take. Are you holding shares hoping for a squeeze, or are you staying away until the dust settles? Let us shift gears to the fundamental engine that is sputtering or failing to start under the hood. The company recently released its third quarter results for the 2025 fiscal year, and the numbers paint a picture of a business shrinking in an attempt to survive. Revenue came in at $70.2 million. While this beat some lowered expectations, it still represented a decline of over 13% year over year. When a growth company stops growing, it loses its valuation premium. But when a growth company starts shrinking while still losing money, it enters a distressed valuation territory. The gross margin printed at roughly 10.3%. For a food company, that's perilously thin. It leaves almost no room for error after you account for operating expenses, marketing, and logistics. The net loss was over $110 million for the quarter. You don't need a PhD in finance to see that you can't sustain $100 million losses on $70 million of revenue forever. The math simply doesn't work without external capital injection. This is where the recent debt news becomes the critical piece of the puzzle. The company executed a massive debt restructuring of its convertible notes. In plain English, they swapped debt that was due sooner for debt that is due later, in 2030, but at a much higher cost. The new notes carry a 7% interest rate or higher if paid in kind. They also issued a staggering amount of new equity to these bondholders to get them to agree to the deal. We're talking about hundreds of millions of new shares. This is textbook dilution. If you owned 1% of the company before this deal, your stake has been dramatically, significantly cut down. The pie got bigger, but your slice got smaller, and the pie itself is tasting a lot less sweet. This dilution is a major reason why the stock is pinned near $1. The market is absorbing this flood of new supply. Investors need to understand the concept of death spiral financing. I'm not saying that's exactly what's happening here, but the symptoms are similar. When a company has to issue more and more shares to pay its bills or satisfy debt holders, it puts constant downward pressure on the share price. As the price drops, they have to issue more shares to raise the same amount of money, which drops the price further. It's a vicious cycle. Beyond Meat is trying to break this cycle by cutting costs, slashing inventory, and exiting unprofitable markets like they did with the suspension of operations in China. These are the right moves for survival, but they are painful. They signal a company that is retrenching, not attacking.
The expectation among loyal fans was that the mainstream adoption of plant-based meat was inevitable. They believed that environmental concerns and health trends would lift a secular shift that would lift all boats. The reality is that the category has faced a massive headwinds from inflation. When grocery prices soared, consumers traded down from premium plant-based burgers to cheaper animal proteins or traditional staples like beans and lentils. The flexitarian consumer, the one who eats meat but tries plant-based options occasionally, proved to be very price-sensitive. Beyond Meat positioned itself as a premium product, and in an inflationary environment, premium is the first thing to get cut from the budget. This macroeconomic pressure is the invisible hand pushing the stock down every day. Now, let's look forward. What are the scenarios from here? There are essentially two paths. Path 1 is the turnaround. In this scenario, the cost cuts finally take hold, the cash burn drops to zero,